Hello, everybody, and welcome to Public Live. I am your host, Kinsey Grant, and we have some breaking news to dive into today, so let's not waste any time diving in. Earlier today, the Federal Reserve approved its largest interest rate increase since 1994, which, if you are me, means the Federal Reserve approved its largest interest rate increase in your entire Fed watching life. The Fed greenlit a 0.75 percentage point increase, which lifts the Fed's benchmark federal funds rate to a range between 1.5% and 1.75%. It's a pretty bold measure from the central bank as it stares down the challenge of combating inflation, which is at 40-year highs, without completely crippling the economy in the process. It's complicated work, as I'm sure you can imagine, which means that there are some complicated side effects that go along with it. The market has responded big time to this interest rate news, and it's time to understand how, why, and what comes next. We're going to do that with our fantastic guest today, Jason Ware. He's the Chief Investment Officer at Albion Financial. Jason, welcome to Public Live. How are you doing today?
I'm doing okay. It's good to be with you, Kinsey. Thanks for having me.
Of course. Really grateful for you stopping by today. I'm sure it's
Sure.
been a bit of a hectic day. Obviously this decision we knew was coming. This is a 2-day meeting. Typically the FOMC gets together regularly to have these meetings to talk about interest rates, but it doesn't make it any less, exciting is perhaps the word of choice here, to try to dissect exactly what all of this means, especially for the market. So let's start with that. I want to get into the market reaction to this interest rate increase. My account here on Public is looking a little greener than it has for the last couple of weeks. Markets seem to be responding pretty well to the rate decision, but talk to me about what you're seeing out there. What's your initial reaction here?
Yeah, so I think this is a very classic buy the news type of situation. We had to, sell the rumor when it looked pretty clear earlier this week, Monday in particular, that the Fed was going to go 75 basis points at this meeting as opposed to 50. And there was certainly a violent reaction when that started to permeate financial markets, but markets adjust quickly. And I think going into this meeting, everyone, including the Fed funds futures market, which was pricing almost 100% move of 75 basis points, this was well telegraphed at the last minute, and markets were prepared accordingly. So I think what we had here is a buy the news. We got the news in. We've now digested some of that medicine. It appears that the Fed is going to be even more aggressive in bringing down inflation. And oh, by the way, inflation is the biggest challenge right now to stocks and financial markets, and quite frankly, the economy. So I think it was well accepted because what we're now seeing is a Fed that says, you know what, we recognize we're behind the curve. We're going to do everything we can to bring down inflation. And if we can get inflation down, I think that solves a lot of problems that we're seeing in the equity market.
Yeah, and you hit on a lot there, Jason, that I want to dig into in this conversation as we speak through the news that happened and, of course, what comes next, not the least of which being that this decision to do 75 basis points instead of 50 was something that markets had not necessarily priced in just a week or so ago. This is more of a recent development. We'll get to that in just a minute, but before we do get to that, I want to understand a little bit better why the market does seem pretty keen on pretty aggressive policy here. Like I mentioned, we're talking almost 30 years since we've seen a rate increased at this level. And you mentioned that this is the Fed's means of trying to get more in front of the curve, less behind the curve when it comes to inflation. But why are publicly traded companies so concerned about inflation right now? Can you give me any context for why this matters so much?
Yeah, of course. So inflation is one of the most challenging things that financial markets deal with because, it erodes the real value of both earnings and sales and, quite frankly, consumers' purchasing power. So when inflation starts to become unmoored and get out ahead of expectations, it's the Fed's job to try to rein that back in so we can have a more balanced economy. And a balanced economy is a good economy. It's a healthy economy for jobs, for wages, for consumption, for investment. So it's a very important variable that central bankers pay very close attention to. And that can, again, permeate through the stock market, both in terms of real growth, but also just as important in terms of valuation. When inflation is high, interest rates are typically higher, as we're seeing with the Fed, right? The Fed is very directly trying to push down inflation by raising interest rates. And when rates go up, valuations have to come down. And we're seeing that in earnest in the stock market. So it can be a bit of a adjustment period when inflation runs high. and equity investors are feeling it. We've seen, the S&P 500 before today and yesterday was down 22% year to date off its highs. NASDAQ was down 33%, small caps down 30%. So we've seen a big adjustment in stocks, primarily on valuation, which is a function of rates and inflation, even though the economy and earnings are holding in well.
Are there any specific sectors that are most vulnerable to inflation, and I guess kind of in tandem, if they are more vulnerable to inflation, that they are subsequently more vulnerable to Fed strategy?
Mm-hmm. Yeah, great question. And the answer is yes. There are certainly some sectors that fare. I mean, let me just back it out real quick. Stocks, because I want your listeners to understand this is very important. In inflationary environments, stocks are one of your best investments, just writ large, well diversified, good companies are great investments. That and real estate or in hard assets are some of your best investments. So with that said, there are certain varieties of stocks, sectors, factors, et cetera, that tend to outperform in inflationary environments and in higher interest rate environments. For example, technology companies of high growth, long duration, meaning they're not earning cash flows and profits today, but there's a promise of that down the road because they're high growth and they're putting all of their revenue back into growing their business. Companies without earnings and with high valuations typically don't do very well. They do very poorly, and we've seen that. NASDAQ down 33%, but under the hood of the NASDAQ, we're seeing, some of the pandemic darlings, some of these, high tech, the Cathy Wood type stocks, if you will, down 60, 70, 80%. We saw that in 2000 with the dot-com bust. So companies that are trading on price to sales with no real earnings are by far and away in the crosshairs when we see inflation elevated and when interest rates are going up and the Fed is aggressive on monetary policy. There are other areas within the equity market, like utilities, believe it or not, don't typically do well when interest rates rise and when inflation is higher. Why is that? Because those revenues are typically restrained by how much they can push through price increases because they're highly regulated by state commissions. Meanwhile, their input costs, that is energy, oil, gas, et cetera, go up. So they get squeezed. And oh, by the way, their yields, which most investors buy utilities for the current yield, which is usually around 3 and 3.5%, when the 10-year treasury is rising and is matching that yield, by relative comparison, a utility company doesn't look as attractive as a safer treasury security of a similar type interest payout. So there are some areas within the market that feel pressure more than others when inflation and rates are up, and those are just two examples of several.
Yeah, and great examples at that. Good, a good tour of the market right now
Kind
that I
of
think
both
is
ends of the
necessary
spectrum, if you
context.
will. Yeah,
Yeah,
both
I
ends of the
love it.
spectrum. Yep.
So you mentioned the concept of selling the rumor and buying the news. Obviously, we are in the buying the news part of that story right now. How long do you expect these equity gains to be sustained? How long do you expect to see that green out there? Is this going to be something that lasts for a while, or is this just a momentary blip?
Yeah, the reality is that question is of the most interest to your listeners because it's really like, what's the market going to do from here? And yet it's the most difficult and tricky to answer because the reality is that over the short run, nobody has a crystal ball, and anyone that tells you they know where the market's going to go over the near term is not being intellectually honest with themselves. That said, I know it's a question that everyone has on their mind, so I'll try to provide a framework and some context to how we think about it. Our view is that the items that have been the biggest challenge to the equity market over the last 6 months, i.e., inflation and interest rates, are going to be the items that deliver us from the bear market and start a bull market anew. So, in other words, if we begin to see inflation really start to fade in earnest, and we've seen a little bit of that over the past couple of months. Core inflation has come down 2 straight months. We're down around 6%. Core PCE inflation, which the Fed looks at more closely, is around 5%. If those things begin to really start to roll over here as the economy slows through the course of the summer into the fall, that will likely give the Fed cover to begin to dial back how aggressive they are in monetary policy. So what does that mean? That means inflation's coming down. We talked about why that's problematic for stocks. That means interest rates can start to settle in and perhaps even come down as well. There's a fair amount of historical evidence that suggests that rates can fall even though inflation remains elevated and even though the Fed starts to, even if the Fed's raising rates, but just coming off the accelerator can have some downward effect on long-term interest rates. And by the way, the economy slowing will also have a downward trajectory on interest rates as well. And we're definitely seeing that in the data. The economy is absolutely slowing down, exactly what the Fed wants. If all of those things come to fruition, if we see a confluence of those three factors, then there's a good case to be made that stocks can start a new bull market at some point here. Is today the day? Who knows? Is next week going to be when it happens? Next month? Nobody knows that for sure. We'll only know in hindsight. But if we can get some resolution on two or three of those fronts, then I think we are quite constructive as we look out for the balance of this year. And if we can get past the midterm election, something that most people aren't really talking about right now, but does have an impact on stock markets historically, that's a decent setup if you have a 1, 2, 3 year time horizon.
Yeah, and I think it's important to remember that we do have all sorts of important market moving type events coming up. It's not just Fed decisions,
Right.
it's not just inflation readings, it's not just midterm elections. It's kind of all of it at the same time throughout the year, which I think is an interesting means of trying to maintain that long term view as we move forward after this meeting, knowing, of course, that there will be another Fed meeting in July where they will make a decision, which we'll get to in just a second. But before we get to that, I think it's important now that we understand a little bit of what's going on in the markets today to think about what exactly this means, what this Fed strategy is, kind of in the mechanical sense. If we want to really understand what the impact is going to be on our investing portfolios, I think it's really important that we understand what the strategy is at its core that the Fed is deploying here. So if you don't mind, I would love an explanation, if you will, of what the federal funds rate is, and of course, why higher rates like the Fed is reaching toward right now, why those cause the economy to slow down. So can you explain that a little bit?
Yeah. So the federal funds rate is the main interest rate policy tool that the Federal Reserve has at their disposal to try to dial in the appropriate level of balanced growth for the economy. So they directly control that through open market operations, through their FOMC trading desk and the New York Fed. There's a lot of wonkiness in there. We could spend an entire program discussing just the mechanics of how that works, but just keep it high level. It's the main policy tool they have on the interest rate front, where they move interest rates up and they move interest rates down, and that filters into other credit instruments in the economy. Directionally, if the Fed funds rates going up, then we should see savings rates going up. We should see auto loans going up in terms of the interest rate. Housing, we've obviously mortgage rates back up dramatically this year from a little over 3.5% to start the year to north of 6 right now. So that's the main policy tool they use to try to increase the cost of money or decrease the cost of money, which has an effect on economic growth. So the reason that matters, and I kind of just mentioned that a little bit, is because as the cost of money goes up, in other words, the interest rate to borrow, and in our economy is very much, at least at the margin, subject to credit as a function of economic growth, as a function of economic activity, where it's credit cards, auto loans, mortgages, businesses taking on loans to grow. So as the Fed raises those interest rates, that makes the cost of that money more prohibitive and therefore slows down activity. Investments, if you're at a business thinking about opening a new plant or buying a new building or investing in new equipment, those decisions look a little bit different as interest rates rise. If you're a borrower thinking about buying a second home or buying a new home or taking on a new line of credit, the calculus of that looks a little different. So quite frankly, what it does is it just constricts a little bit the availability of money and the access to credit, and can thereby slow the economy by slowing aggregate demand for goods and services.
I think this is a great spot to transition to the idea of the soft landing, which is a pair of words that people have probably read a lot more in recent weeks and months than they traditionally have in most of their consumption of stock market news. The idea of the soft landing, I would love if you could explain to me what that means and maybe just give some context as to what the Fed does that, while we are seeing some green in our portfolios today, I'm sure many people are, the idea here is that the Fed is trying to slow down the economy effectively to make money a little bit harder to borrow your words, to increase the cost of money by increasing the rates. So talk to me about the soft landing, what it takes to get there, and how the Fed's strategy today, while it might seem like a boon for this trading session, might also be something that is a tool designed to slow things down.
Yeah. So the soft landing in its most simplest form is getting inflation back to target without creating a recession. Historically, that's been a difficult tightrope to walk. Oftentimes, the Fed will take it a little too far in tightening policy to slow the economy or to bring inflation down. And because interest rates and monetary policy is such a blunt tool, it's hard to fine tune it. And I'm going to target this sector or target this level of growth or this level of unemployment. What happens is because it's a blunt tool, it slows everything down pretty dramatically all in an instance. And that can create recession if they take it too far. And the Fed, unfortunately, has a pretty checkered past in being able to negotiate soft landings, especially when inflation is elevated like we see today. So essentially, it's just bringing inflation down back to that 2% target while you're not raising unemployment too much, which is quite frankly a function of whether the economy is expanding or contracting. So the soft landing is going to be difficult. I think we give the Fed a sporting chance at making it happen. It's not going to be easy. It's going to depend on how quickly they raise rates, how aggressive they are, and quite frankly, how the path of normalization for the economy. So with that said, how does that kind of feed through? The second part of your question had to do with I'm sorry, remind me. I just want to make sure I answer your question in full.
Yeah, thank you. No, I appreciate it. Just the idea that, these tools and blunt tools at that
Yeah,
are tools that are designed to slow things down. Typically, we do not love the idea of slowing things down.
right.
So I would just love to hear your
Okay.
perspective on that.
No, the reality is we should all celebrate a slowdown. And I know that sounds weird, and we've shared that with clients for the last 6 months. We spent most of 2020 and early 2021 calling for a big boom in the economy, given like the reopening from the pandemic and all of the money that was being put in the system, both on the fiscal and monetary side. We got that call correct. And at the end of last year, we started preparing our clients for what we were calling the year of normalization. That is 2022. And the reality is you can't grow the economy at 5-6% a year forever. Because if you do, this is what you get. You get high inflation, you get distortions, you get dislocations across labor markets and wages and mismatches in skill sets and malinvestment and all sorts of things that require a recession often at times to cool things off. So you don't want heady growth every year. What you want is balanced, predictable growth every year. So the normalization, both in terms of just the backside of the pandemic, but also the Fed trying to negotiate a cooler economy, is something that we should welcome. I'll remind your listeners that if you go back to the prior decade, the expansion from June of 2009 through the recession in February of 2020, that was an 11-year expansion. And part of the reason, the longest expansion on record, and part of the reason we had that long expansion is because we had very balanced growth. We had about 2 to 2.25% real GDP growth. That was good for jobs market. That was good for consumption. It was good for investment, and it didn't overheat the economy. So the Fed wants things to slow down, and we should want them to slow down as well, because it provides a much better economy for everybody, and it provides a much better market for everybody. So we actually celebrate it, and we think a slowdown is something we should all lean into.
Surely there is a tortoise and a hare analogy somewhere in there.
Indeed,
But I think,
indeed.
yeah, the point is well taken that normalization is not necessarily something that moves in a singular direction. I think that's important to keep in mind. Now, I want to zoom out for a second here to understand some of the factors that we're talking about kind of at the macro level. We have a quote from Jerome Powell, Fed chief, said, "What is becoming more clear is that many factors that we don't control are going to play a very significant role in deciding whether it's possible or not, meaning to come out of this toward a soft landing area." And he said it's not going to be easy. So I would love if you, Jason, could explain to me what some of the other factors are here. It's not just the blunt tools in the Fed's playbook here. We have other factors that are going to impact the future of the economy, both in the near term and in the longer term. What are some of those factors?
Yeah, great question. And I imagine what Mr. Powell is referring to is just the absence of shocks. We've had a number of economic shocks over the past 2 years that have just, really just kind of swelled up over the transom, if you will, whether it was a pandemic in 2020, and then we had a war in Ukraine earlier this year that's still ongoing. We've had supply side shocks in terms of dislocations of supply chains and logistics that have made inflation worse. We've had commodity shocks, in part due to geopolitical events, but there are other things going on as well. So what the Fed has had to deal with over the last 2 years, quite frankly, and we've seen this in their policy, right? They were really accommodative for a while, and now they're going really restrictive. And Neil Kashkari, the president of the Minneapolis Federal Reserve, commented a couple of weeks ago in an essay where he said, "We're now removing accommodation faster than we gave it." And so those big pivots, those big swings in Fed policy are really a reflection of what's been a couple years of just repeated shocks over the transom. So I think in the absence of any further economic shocks on the supply side or the demand side, the Fed's job looks pretty straightforward. We have inflation. We need to bring inflation down. We know how to do that. The good news is central bankers can deal with inflation a lot easier than they can deal with deflation. Deflation is a much bigger problem. We don't have that. We have inflation. We know how to get inflation down. So we just need the Fed to do that in a way that is somewhat predictable, somewhat measured, and not tip the economy into recession. We'll see what happens there. We certainly are not mission accomplished is not something we want to say yet. But I think if we can remove the calculus of shocks, and unfortunately we have no control over that. I don't, you don't, the Fed doesn't. Nobody has control over whether or not we're going to keep getting hit with these external events that make this difficult. But if we don't have any of those, if we can get into a path here where it's just monetary policy as a normal course of dealing with inflation, I think the odds of success for them go up. And that's the good news. So we'll see how it goes. We'll see how it fleshes out over the next 3, 6, and 9 months. But the Fed knows what it has to do, and it's working toward doing that.
Absolutely. And a great transition here to talk about what comes next from the Fed. I want to, before we get into that, understand this kind of last minute, I don't want to call it a pivot, but maybe a last minute ramp up in terms of how intense this was going to be or not intense this was going to be. So for the last several weeks or so, most of the Fed officials and most of the readings from the market itself had implied that we expected a 0.5 percentage point move, that was going to be the most likely strategy to deploy from the Fed. Then another high inflation reading came last week. Obviously, things changed. So can you walk me through what that strategy was like for the Fed to determine that they were going to have to ramp things up perhaps a little bit more quickly at a faster pace than previously expected?
While it was unsettling, I think, for all of us to learn that the Fed was going to take up, let's just a little history. 3 months ago, they were going to do 25 basis points, maybe 4 to 5 times this year. And then all of a sudden they went 50 basis points in June. And I shouldn't say all of a sudden, they prepared markets fairly well for that. And then here we are, right before the next meeting talking about doing 75. So there's been a lot of jolty moves higher with like incrementally more hawkish behavior and tone from the Fed. And the most recent one over the last 2 to 3 days was a bit shocking for everyone. We saw that in the markets on Monday, and we saw that in the markets on Friday to some degree. There was no bid in the mortgage market on Friday, which has only happened 4 times in the last 40 years. So we've seen a number of like dislocations in trying to prepare for what was a 75 basis point hike today. I think what that demonstrates is the Fed is in fact data dependent. Right? I mean, we had some new information that came out. Jerome Powell has told us all along the way that as new information comes in, we're going to adjust policy accordingly. And what they got on Friday was a CPI that had them nervous. Yes, core came down, but headline took a new leg up. And that will filter through to the economy. And that is not showing to them that they have the consistent fading of inflation they need to see to get off the accelerator. In addition to that, we had a couple of key consumer survey reports that looked at consumer expectations for inflation. We had a University of Michigan on Friday that showed numbers going up a little bit, and we had the New York Fed's consumer survey as well that showed inflation for over the next 3 years held steady at 3.3%, but the distribution of outlook got much wider. So in other words, there were more people in the survey that said, ooh, inflation might be higher over the next 3 years than I originally anticipated. Those, in addition to the CPI, I think told Jerome Powell and co. that they really got to get out ahead of this. And you know what? 75 is going to hurt. And people are going to be a little bit surprised by the sudden ramp up in hawkishness. But better to apologize down the road for a dramatically slowing economy than to let inflation get out of control and become untethered. And they made that decision accordingly, and it shows they're data dependent, and it's probably the right call.
So with that in mind, knowing that the Fed is, at least right now, data dependent, is there any way of predicting what the expectation is for the FOMC's July meeting?
If you can tell me what inflation is going to do between now and July, then I can tell you whether they're going to go 50 or 75. And I think the good news is, Kinsey, is if you listen to Jerome Powell at the press conference today, one of the things that kind of sparked the leg up in the equity market during the press conference was basically when he said, we understand 75 basis points is a lot. And by the way, to your point, it hasn't happened in 28 years. However, as we're looking at over the next couple of meetings, we think somewhere between 50 and 75 is appropriate. So in other words, he kind of backed off 75 for July a little bit. I wouldn't take that as a forecast. They may very well do 75 again. I think if things don't change, i.e. inflation doesn't inflect lower, we don't see disinflation taking hold in earnest, then they probably will do 75. But he did open up that range of possibilities of saying, look, we might go back to 50 in July. We might do 50 in September. Don't just pencil in 75 between here and like eternity. We're going to continue to be data dependent, and we may back off here if inflation allows us to back off. So again, if you can tell me what CPI and PCE are going to be and what these consumer expectations look like, and quite frankly, market-based expectations like the 10-year break-evens, 5-year forwards, the tips curve, if you can predict that over the next 6 weeks, we'll know what they're going to do in July. But it'll be somewhere between 50 and 75.
And if I could predict all of those things, my life would look very different, wouldn't it?
Oh, yeah. You
Okay,
and I would
Jason,
go to Vegas.
Yeah, exactly. I've got one last big question for you here before I let you go. The idea that the Fed implements these strategies that, of course, impact the markets and those market moves impact, of course, anybody who is an investor. That makes a lot of sense. But I think in the bigger picture, I want to understand what higher interest rates mean for everyday people outside of what they're doing here on the public app, outside of sending maybe some of the stocks in their portfolio higher for however long. What does an interest rate increase mean for me or for anybody else listening to this in our everyday kind of normal going about our lives, not necessarily as investors, but just as regular everyday people? What does that mean?
Yeah, great question. So removing the stock part of it, and i.e., you feel less wealthy today because your 401k is down to your IRA. Outside of that, it means that you're going to pay. There's two things. It means you're going to pay higher costs to borrow money. So if you're looking for a new home, if you want to get a credit line on your house to do some yard projects or to build a second story or something, that's going to be more expensive. If you want to go buy a new car, that's going to be more expensive. Now, of course, car loans, you don't really see a whole lot of like incremental cost with regards to, like, if the cost of a car loan goes up from 3.5 to 4.5% over 6 years on the balance of a car loan, it's not that expensive. But on a mortgage, you're going to notice that. You're going to see a big difference between 3.5% 30-year mortgage and a 6% 30-year mortgage, especially given where home prices are. As we all know, they're very elevated. So you'll see that show up in the cost of debt. Credit cards are going to go up to some degree. But I think the good news is, in the silver lining on the other side, is that you're also going to get more in terms of your savings, right? The money you have parked at banks in CDs and general savings accounts, even checking accounts, your money market funds, any credit lines you have, at the brokers where you're, holding like brokered CDs, all of those things are going to see bonds. If you own bonds, if you have any listeners that own corporate bonds or treasury bonds, you're seeing the expected return on those safer products go up. And by the way, everybody on this call knows that over the last 10 years, it's been difficult to even beat inflation on any of those, because we've been at such low interest rates on any kind of savings vehicle. Now, we're not beating inflation right now because inflation is high, but if the Fed can get inflation down, and if rates remain where they are today or somewhere in the zone, not at zero, but better than zero, then I think the money you have parked in CDs and savings, core savings, looks a lot better today than it did just 6 months ago. So I guess that's the silver lining and the good news to offset the higher cost of borrowing.
All right. And that is incredible insight. Jason, this has been such a wonderful conversation. What a quick way those 30 minutes went by. I think that this has been one of my favorite Fed conversations that I've had to
Thank you.
date on this app or anywhere else. So, Jason, I
I,
really, really appreciate your insight here.
I appreciate you giving me the time to stretch the legs and chop it up with you. It was a lot of fun. Let's do it again.
Yeah, absolutely. Well, thank you so much for being here today.
You
And
got it.
thank you to all of you out there for listening as well. Happy Fed Day to all who celebrate. We will see you back here soon on the public app. I hope everybody has a great day, great rest of your Wednesday. Talk to you later.
If you would like to see more content like this, subscribe to our channel and download the public app where you can listen to these sessions in live time.